In this short recording, we're going to look at the concepts of markup and margin. So in week 2, we focused on how you might go about costing a product or service. All right? And as well as that, it's ensured that when you're interested in costing a product or service, you of course want to know what revenue you earn from it as well. So it's intuitive for most people to understand how do I come up with whether it's a profit or a loss on a product or service, is you compare the revenue to the cost and you take one from the other. However, there's other concepts and terminology that can come up in business, such as markup and margin, that are essentially using those numbers, the cost of a product and the revenue of a product, but using them and presenting them in different ways in terms of percentages that can often be confusing to students. So we're going to try and explain this and use a couple of real life examples as well. All right. So they're common terms and they're looking at the relationship between profit, costs, and revenues. And particularly if you're involved in retail or sales or pricing, tenders, or anything like that, so across a whole range of industries, they're very important concepts. And the problem is a lot of the time they're mixed up. Some people will assume, oh, so markup means the same thing. If you said 20% markup, that's the same as 20% margin. They're two distinct concepts. Yes, they will use a lot of the same figures, but they actually have two different answers. So if you misinterpret them, you can end up having bad negotiations, bad prices, and ultimately it's going to go wrong for you. So it's important you do know the difference. So what the formulas are, markup is profit as a percentage of cost. So you get your profit by getting the revenue minus the cost. And then you take that profit and you put it as a percentage of cost, i.e. it's a markup on cost. You're marking up your cost to get your price. Margin, on the other hand, is profit as a percentage of revenue. So what you're saying is you get your profit and divide it by revenue. So that'll tell you what percentage of revenue you're turning into profit. And of course, you can use different margins. You can use gross profit and get a gross profit margin. You can take operating profit divided by revenue, get an operating profit margin. It just depends. Different industries will look at different margins depending on which line item in the financial statements they look at. And we will look at a lot more in terms of gross profit, operating profit, and net profit when we look at financial statements in section 5 of the module. So the key point here is, although they're using all similar things, because profit is revenue minus costs, so they're all using very similar figures, they're using them in different ways, and you're going to get two different answers. They both will be percentages, but they will not be the same. And what you need to watch for as well, particularly if you're in certain industries like retail, you work in a supermarket, a restaurant, remember you have to take account of VAT. Right? Is VAT included there? Because that can drastically change what your answer will be. And we'll show you that in an example as well. So the simple things that students are going to get caught out on, but these are very important because a lot of negotiations and deals with suppliers can be done on a markup or margin basis. So to give you a small example, say a retailer purchases cereal at 250 a unit, so that's their cost from its supplier, and then sells it to the end consumer at 350 a unit. So it's very simple there that we know the profit per unit there is €1. However, if we were describing, well, what markup did you earn there? You earned a markup of the profit, €1, divided by the cost, 250. And if you put 1 divided by 250, you get 40.4, which in percentages, you multiply by 100, is 40%. So they could say, actually, I want to price this to get a markup of 40%, so you would price it at 350. However, it's also correct to say that the retailer earned a margin of 28.6%. What we mean by that is you put the profit earned over the revenue, i.e. what you sold it for to the end consumer. So the profit is still 1, but the revenue is 350, that's 28.5%. So the markup will always be larger because you're dividing by cost, which is always going to be smaller than revenue. So it's important to be careful when you're using your terms. Are your suppliers talking about margin or talking about markup? Because again, a lot of the time negotiation is based on, well, I want a minimum markup or margin of X%, and then you have to base your pricing on that. So it's very important. And we've ignored VAT there. We'll see in a minute that does play a part as well. Right, so just be careful of how you approach each of those. To give you a real world example, I've taken a PDF that I got online from Musgrave Marketplace, which is essentially the wholesalers. So Musgraves will sell to the smaller shops of the independent retailers about different items in the shops. So I just took one, it's from the World Cup promotion cycle 2018, because I can get a PDF. So you can see they say this is what Musgraves Wholesale are selling to the retailer at. So they could be selling to a smaller independent corner shop, etc. So this is the case price. and UCIV stands for unit cost including VAT. So it depends how many big packs of potato are in a box or a Kinko. So if we come down and take one example just to show you, take for example maybe Fairy Liquid there as one good one. All right, let's see here. So the Fairy Liquid there, it's $21.99 a case because of course these are sold in boxes, and you're told there's 16 bottles in a case. So we're saying, well, where are they coming up with this 169 a unit? Well, here, $21.99 for the case, right? And it's 16 bottles. So that's 137 a bottle. Of course, what you have to remember is you have to pay VAT if you're buying it as well. So VAT back in 2018 was 23%. So that's where your 169 comes from. You're buying at $21.99 before VAT, but you have to pay VAT at 23%. Then the RRP here, the recommended retail price, is $2.50. That of course includes VAT as well. So if we write this down, maybe I'll just put a smaller one here just to make it easy to see. So let's look at his here. We have RRP 250. We have cost 169, and that gets us the profit per bottle, because we're looking at per bottle basis, 81 cents. And all of those include VAT. So that means here my margin is going to be 81 cent divided by the recommended retail price, which is what the end consumer is paying, i.e. what your corner shop is selling it out at, and that will get me my 32%. That's where they call it POR. It's known in the industry as price or profit on return, otherwise known as margin. But that's what they're looking at. They're saying if you buy it at that, you can earn a margin of 32%. So for example, if we go and look at a different one then, let's go down and say, look at, for example, bottle of water. Profit on return 67%. So very profitable here for a retailer that's buying it. So you're saying you buy a case of water for $6.35. So $6.35, there's 24 bottles in a case, 26 cent. But again, you add on the VAT, which is 23%. So that's your 33 cent a unit, they've rounded, and you sell it for €1. So €1 you sell it for, including VAT. Take off the 33 cent that you're paid it for, leaves you with 67 cent divided by the revenue, which is the €1, 67%. So your margin there is 67%. But if you wanted to go markup, it would be, just be careful, 0.67 divided by 0.33, which is 200%. Because you're getting more than double in terms of the price. So just be careful in terms of how you watch it here. Your cost per unit is 33 cent, but you're selling it for a profit of 67. So profit over cost gets your percentage. So that's a very big markup in terms of what they're selling Ballygown still water for. So you can go down and have a look at each of them just to get an idea of where it's coming from. Remember, the UCIV now stands for unit cost, including VAT, because of course VAT is a part and parcel of business, and to understand how exactly those figures are coming from. So it's a good practical examples of how those calculations work. All right. So attempt the short questions that I've given you. They're up on loop as well, because they're not always going to be asked just calculate a margin. I might ask you what price do you need to charge to achieve a target margin as well. So you're going to come across these a number of times in the course through exam questions and through smaller tutorial questions. So make sure you do understand the difference between markup and margin.